Plenty of people have heard about what we call the PayPal Mafia. They're a group of former PayPal employees and founders who went on to found many of the biggest tech companies in the world today, from Tesla Inc. to LinkedIn to YouTube and many more. What you might not know is there is a far more malevolent group of financial racketeers out there in the Goldman Sachs Mafia, those who went out and assumed far more powerful positions of leadership that affect far more of the world. This is the story of how Goldman Sachs became the most powerful bankers in the world. Goldman Sachs is excellent at making money and one of the pinnacles of Wall Street. Of all the older generation of investment banks, Goldman Sachs is the biggest, having almost $1 trillion in assets. Some say they are the evil empire of the banking world, and the appeal of working for them certainly lines up with that thinking, as many who have worked for the company have gone on to become the rulers of the world. Not ruling the world in the cartoon sense either, with a dictator on a throne laughing maniacally, but more of a group of people who make decisions that influence world leaders. There are a group of people that are both admired and hated, and this has been true throughout Goldman Sachs' history. People would try to emulate the company since they got out of the global financial crisis with hardly a scratch. However, this came at the cost of their reputation. Now the bank has shifted gears from investing to targeting the average member of the public instead of the wealthiest and most important people. The story of how this came to be is fascinating and begins in 1869. Back then, a Bavarian immigrant called Marcus Goldman began peddling products in Philadelphia before investing in a sewing machine and becoming a tailor. Finding a certain level of success over a couple of decades, he moved to New York City and opened a bank, buying notes payable from local downtown businesses and manufacturers and selling them for a profit. By 1882, things were going well, and he invited his son-in-law, Sam Sachs, into his operation, renaming it Goldman Sachs and Company, as was the style for small businesses at the time. 3 years later, Goldman's son Henry joined the firm, and he would go on to profoundly influence the financial world over the next few decades. Around this time, Goldman Sachs also became part of the New York Stock Exchange, and Henry poised himself to gradually take over the business. Realizing that retail firms were looking for capital to expand but couldn't get the assets they needed, and Henry Goldman saw a chance to innovate the world. Henry Goldman was the man who had the idea to use a company's predicted future earnings and its ability to generate income later to value the company. This strategy was essential in leading to Goldman Sachs' first initial public offering in 1906 in United Cigar. The model had worked and would become the model by which all IPOs would work. In fact, it worked so well that Henry Goldman was actually the one behind over 50 of the U.S.'s most prosperous public corporations. Despite the Wall Street crash, 5 decades of success followed. Goldman Sachs was at the forefront of United States banking, taking multiple companies public and building powerful relationships. One of the biggest events for Goldman Sachs was during the 1950s, when they were permitted to underwrite the IPO of Ford Motors. There was a history of anti-Semitism from the Fords, but that didn't stop Goldman Sachs, and the company thrived soon under Sidney Weinberg. They had up to 75% returns on equity. But the big one was coming in 1957, when Goldman Sachs led the IPO of the Walt Disney Company, following the opening of Disneyland in California. Incredibly, by the 1970s, Goldman Sachs had become known as the pinnacle of the investment banking business. They were known for having extremely high standards of quality and a culture of having only the best and brightest people working for them. However, things began to shift as investment banks increasingly turned public during that era, and the whole environment changed from investment banking being highly risk-averse privately to an encouragement to take bigger risks with client money. With a change like this, the leadership positions within Goldman Sachs also shifted towards the trading sector. Rival company Bear Stearns went public in 1985, followed soon after by Morgan Stanley in 1986, while Goldman Sachs made some truly huge deals, purchasing Rockefeller Center in 1995, but always decided to stay private. The thinking was simply that they were different, special even, and so if they could eventually go public at 4 times the book value, they would make absolutely tons of cash. Finally, in 1999, the Goldman Sachs IPO happened, becoming one of the biggest IPOs that had ever happened and raising the company $3.7 billion. All of the partners became incredibly rich overnight, with various partners making between $100 and $300 million apiece. Goldman Sachs was not simply dominating the financial sector either. They had wormed their way into politics. When you've made incredible amounts of money and are still fairly young, the only logical question is where to go from here, and an ethical pivot began to happen. Under the guise of wanting to give something back, the partners really wanted the only thing they didn't have: true power. The kind of power you can only find in Washington. John Whitehead, senior partner at Goldman Sachs, had worked for Ronald Reagan. Robert Rubin became a national advisor for Bill Clinton, becoming Treasury Secretary later, and many others influenced American politics over the years. Even today, the former partners of Goldman Sachs are involved in political moves, especially where finance is concerned. The reality is that Goldman Sachs was always staffed by highly intelligent people, and as those people crave power, the term government Sachs has been used around the world to describe the kind of revolving door that seems to be in place for Goldman partners to find their way into some of the most powerful positions in the world. No other company has sent more people into the political sphere than Goldman Sachs, and very few investment companies were making the kind of money they were. By 2007, their annual profits were over $10 billion a year. The company was split into three sections: investment banking, much as they had been in the beginning, trading and principal investments, i.e. betting on the market, and asset management, advising investors and offering financial planning services. It was the trading sector that produced these incredibly high profits and made Goldman Sachs the poster boy for Wall Street. Of course, as we all know, something terrible was looming, and the bubble was about to burst. Goldman Sachs were the kings of the IPO during the rise of the internet, taking many companies public like Yahoo, eToys, and Webvan, some successful, some less so. However, the dot-com bubble burst, which wiped out $1 trillion on the NASDAQ. Goldman Sachs, however, were not really punished over this, receiving a $110 million fine. That might sound like a lot, but to a company like Goldman Sachs, it was nothing. The company was paying out $7 billion a year in salaries at the time, so it was almost like simply having to pay a business tax. They realized that they could make huge profits from a financial crisis, which was good, because the biggest one yet was around the corner.
Boy, that Timberwolf was one shitty deal. How much of that shitty deal did you sell to your clients after June 22, 2007?
Mr. Chairman, I don't know the answer to that, but the price would have reflected levels that they wanted to invest in.
Oh, of course.
In the 2000s, the loose regulations meant that there was a lot of money to be made in mortgages. Whereas homebuyers once had to prove their stable income and be able to provide a 10% down payment on the property, after the millennium, it became a lot easier. Basically, anyone who had a bank account could get a mortgage, and Goldman Sachs gave out plenty of them, even if they knew they were bad. Despite this, Goldman would get credit default swaps handled by companies like AIG, meaning that when people couldn't pay, AIG would reimburse Goldman Sachs and handle the defaults. Goldman Sachs clearly knew that they were building a time bomb. This was all made possible by Robert Rubin, a Goldman alumnus mentioned earlier who was working in the Clinton administration. He was the one who had made sure that Congress passed the act that protected investment bank abilities to sell mortgages that might default. He's not the only Goldman guy that played this role as Secretary of the Treasury, though. Henry Paulson, after 3 decades with the company, left his position as chairman and CEO of Goldman Sachs to take up the Treasury Secretary mantle in 2007. When the mortgage bubble crashed, it crashed horrifically, causing multiple banks, investment brokerages, and finance companies to crash with them. Lehman Brothers, a rival of Goldman Sachs for a very long time, suffered immensely and received no help at all from Paulson as they went bankrupt. He was also responsible for the $700 billion bailout that banks received. One of the companies that received this vital shot in the arm was AIG, ensuring that they would be able to pay back Goldman Sachs. Another way that Goldman Sachs avoided the crunch of the financial crisis was to redub itself from an investment bank to a bank holding company. With all the help they had received from their alumni in Washington, they got out of the financial sector relatively unscathed, even being able to pay their employees $11 billion in bonuses in 2009. The only way that the company suffered at all was by having to pay a paltry $14 million back to the Treasury. To put that in perspective, it was less than 30% of the CEO's salary that year. Goldman Sachs had always prided themselves on being the best risk managers on Wall Street, and that was certainly made easier when the government would bail them out of any risks that they had lost on. It was at this time that the public began to take more interest in Wall Street and Goldman Sachs, and not in a positive way. It's not a big surprise when Paulson had gifted the industry $700 billion of taxpayers' money. In essence, people realized that Goldman Sachs was selling a product that the trading division were also betting against. They were gaming the system. If the mortgages went well, the company would have made enormous amounts of money. If they didn't, the company would make enormous amounts of money. It's easy to understand why Joe Public didn't appreciate them, especially when they were routinely roasted in court. The company did not do all that they could to defend themselves, but what they did do seemed sketchy and defensive. This is why they have come to be known as sharks, or a sort of finance mafia, as people lost their homes and Goldman Sachs got away with it. After the crisis, but before it was over, as is to be expected, the public were extremely averse to putting money into complicated financial structures that could easily be manipulated against them. And so, Goldman Sachs needed a new strategy to make money, and so they entered the commodities market. Gas prices had gone up during the financial crisis, hitting $4.11 per gallon. At the time, the rising gas prices were blamed on short supplies of crude oil, but in fact, the supplies were increasing, and so demand was going down. Most anyone will know that when supply is high and demand is low, the price of a commodity goes down. So why was it going up? Well, Goldman Sachs were involved in trading oil futures, getting their public investors from the housing boom to buy oil at certain prices, making oil and other fuels the best speculative investment. What this means is that a barrel of oil would be traded between multiple investors, each time increasing the price, and thus did the prices increase instead of decrease. However, this was again unsustainable, resulting in the oil commodities industry crashing hard in 2008. Prices plummeted from almost $150 to just over $30. That's not the only thing that was affected by the increased oil prices, though. Since oil was needed to transport food, the prices of food has shot through the ceiling as well. Once again, the normal public were the ones who had to suffer, and Goldman Sachs didn't care as long as they profited. This attitude of callously ignoring the needs of the clients and the public in favor of the company's needs and their bonuses was a closely guarded secret. When people left Goldman Sachs, they usually did it quietly. That was until Greg Smith, a Goldman Sachs vice president, wrote a public letter of resignation in 2012, as well as a book on the subject.
I literally wanted to hit the board of directors over the head and say, listen, I was proud of Goldman Sachs. I worked here for a long time.
In his op-ed, he included attending derivative sales meetings where not one single minute is spent asking questions about how we can help clients. In one famous quote featured on 60 Minutes, he says, "It makes me ill how callously people talk about ripping their clients off." It revealed that everything people thought was going on, and still is. In summary, Goldman Sachs may truly be worse than most corrupt mafia in the United States, experts at selling convoluted products to clueless clients and betting against their success for profit either way. They have participated in major financial fiascos that have seen members of the public lose everything, while the Goldman executives laugh all the way to the bank. As shady corporate executive cabals go, Goldman Sachs must be one of the worst, most evil group of bankers in the world.